Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Today, let's quickly talk about a stock split and a reverse stock split, what it means for an investor, why do they do it, and especially the reverse stock split. We'll talk about that because it's possible to see that for some of these very high yield income-oriented ETFs. So, stock split, that's usually seen as a positive thing, but what really is it? Let's simulate a 4-for-1 stock split. Okay, so you have one share of $20, or you have a $20 bill. If there's a 4-for-1 stock split, you're basically handing in this $20 bill and you're getting 4 $5 bills. That's what a 4-for-1 stock split is, right? Or if you had a $10 bill, and you get two $5 bills, that's a 2-for-1 stock split, basically. So as you probably already guessed, the value of your money, right, $20 or 4 $5 bills is the exact same. So the first thing, that's the most important thing by far to remember, is that the value of your investment does not change, right? You still have $20 in the end. A reverse stock split, let's say a 1-for-4 reverse stock split, is exactly the opposite. You have 4 $5 bills, now you have one $20 bill. Again, no impact on your investment, no impact on your money. You still have $20. I'd like to thank Moomoo, who is today's sponsor. And if you're Canadian and looking for a broker that has a lot of technology and you like to do stock analysis, look no further, because Moomoo is the first broker in Canada to introduce AI into its system. You have an AI chat bot that you could chat with to ask it questions about a certain stock or stock analysis, like earnings per share, etc., to save you time, just like you could see on your screen. And there's also a bunch of other cool features like the auto buy feature, which you could automatically schedule buying stock at a certain time, anytime you want. There's all kinds of ETF comparison tools as well. And as usual, lots and lots of bonuses for new accounts, including deposit just $100 and get $50 cash back, the easiest $50 cash back you could get. Deposit more money like you could see and you get even more cash back. 6% interest on idle funds just sitting in your account up to $10,000. 60 days commission free. They also have the earning season guess and win, where if you guess right, if the stock is going to go up or down after they post their results, you could win some cash and bonus cash as well. So make sure to sign up, try it out, everyone, to take advantage of all these great bonuses, and make sure you see the PII/Moomoo here at the top. You got to make sure you use my referral link. And on top of all these welcome bonuses, Moomoo were generous enough to provide you watchers, my watchers, an added bonus of a $30 Amazon gift card. And all you have to do to get it is a $1,000 deposit on top of all the other bonuses. So make sure to check it out. I'll also put a link to this page here, which will answer all the frequently asked questions about all these bonuses and how they work. So why do they do it? Well, if we just put in, 4-for-1 stock split explained in Google or whatever, and you could read it, but basically, like I just showed you, same total value. The total market value of the company remains unchanged, as does the total value of an investor's holding. So the day after a stock split or a reverse stock split, you'll have more shares or less shares, but the value of your investment is going to be exactly the same. So there is literally zero impact. Why do they do it? Well, a stock split, they do it, it generally indicates a positive sentiment because it looks like the shares are cheaper or more attractive now, right? If a company's at $1,000 per share, now it's $250 a share, it looks more attractive. It's more affordable to buy one share, right? Instead of you need $1,000 to buy one, now $1,000 gets you 4. Or you could actually buy one share at $250, right? Instead of $1,000. So it gives the impression that it's cheaper, it's more attractive. It's really all about positive market perception, right? It also helps with the options market as well, because, if you're doing calls or puts, selling calls or puts, typically, I think all the time, you do that in blocks of 100 shares. So if it's $1,000 a share, it's very, very expensive to do options. So if it's a cheaper share price, it's a bit easier to do options. And like it says here, right? increased liquidity as well. There's more shares. There's 4 times more shares, so there could be more liquidity. So that's really why they do it. Increases accessibility, increase liquidity, and it gives the market a positive perception, right? You feel better owning $4 or $5 bills. You feel like you're richer than owning one $20 bill because you just have more bills, right? You have more shares, more bills. That's really all it is, but it's the same thing. Now, the opposite is a reverse stock split, or 1-for-4 reverse stock split, for example, is exactly the same. If we look here, it says same total value. The overall value of your investment remains the same as the reduction in shares is offset by the increase in share price, right? So yes, you don't have four bills of $5. You have only 1 bill now instead of 4, but you increase the amount, right? So it's the same thing. So why do they do it? Well, this is typically seen as a negative thing, even though the value is the same and nothing happens, right? Nothing changes with your investment. Well, sometimes it's to meet listing requirements. If, for example, a fund is going down a lot, or is like at 50 cents, you need to have a certain amount. You need to be at least $1 or $2 or something like that to actually be listed on the NASDAQ. So sometimes they do it just to prop up the share price artificially to meet listing requirements, I guess, to attract investors as well, which is kind of like, it's the same reason why a stock split is done as well. But because a low share price can make a stock appear less appealing. But this is more for companies. I want to talk about this or explain it more in terms of ETFs. ETFs reduce administrative costs, I guess, probably. But reverse splits typically get a very negative connotation. For example, QQQY from Defiance did it. I think Tesla from YieldMax did it as well. And there was a lot of chatter. Oh, it's bad. It's negative. Oh, it's terrible. It's going to zero. All this crap. So it's very important when you read all this nonsense online and on Reddit or whatever you want. Just remember the analogy, everyone. Okay, $4 or $5 bills for 120. Your investment doesn't change. After a stock split, after a reverse stock split on an ETF, you go in your investment account. If you had you had 10,000, the investment value is still 10,000. The value of your investment, your return, your total return is still 10,000. The most important thing. Now, why is it seen as negative? I don't know why. I guess people can't do math. I guess, I mean, there's nothing more I could say about that. But there's the main thing I want to that you need to remember is that I hear a lot of people saying, especially new income investors, and you might see reverse splits or more reverse splits on these very, very, very high yielding ETFs. And the reason is because the stock price goes down very quickly over time, not because it's a bad fund, or maybe you don't like the strategy, that's fine, but it's because they're giving out a lot of that NAV, right? And then there's that whole NAV. This ties in a little bit in that whole NAV erosion myth, which I have an upcoming video on that. Make sure to check out that video if you believe NAV erosion is still a thing. Make sure to check out that video. But if the NAV is going down and down and down over time because these fund managers or these high yield funds have a very aggressive distribution policy, which means they're giving out these massive distributions every month or every week or whatever it is, like QQQY, for example, right? You could see all them, especially at the beginning, they were giving $1.93 a share if the stock price starts at $20. Of course, the stock chart and the NAV is going to go down over time, but remember that it's because they're giving it out to you, the investor, as cash, right? So it's not eroding, it's being given out to investors. Eroding means they're losing it, or it's a loss, or it's disappearing. It's complete nonsense. They're giving out to investors. So let's say for some reason, you really like one of these funds. You like the assets inside and you like the strategy. A lot of people have a fear that, oh, well, the stock price is going to zero. It's going to zero, right? They see this trend going down. It's going to go to zero. Tesla is going to go to zero. That's not the case, because they could always do a reverse split. Tesla will not go to zero, will never go to zero unless Tesla stock goes to zero. QQQY will never go to zero unless the NASDAQ 100 goes to zero. That's how ETFs could go to zero. It's if the assets inside go to zero. So if a fund manager like YieldMax or Defiance have a very, very aggressive distribution policy, they give out a lot of income, a lot of the NAV out to you, you'll see a stock price or a NAV price going down. But remember, they could always do a reverse split to artificially prop up the price again. So as long as Tesla does not go to zero, Tesla will not go to zero. I mean, think about it, guys. You really think YieldMax is going to let their Tesla fund go to zero when they have $1 billion AUM in it, over $1 billion AUM? They're charging 99. They're basically making about $10 million of fees a year managing this fund. A little bit more than that, actually, 10,100,000, 150,000 or something. They're not gonna let it go to zero, guys. Why would they do that? They could just reverse split to reprop up the price artificially, right? 420, meaning the return, the investment value doesn't change, but now the stock price is higher. So you never have to worry that a very, very high yielding fund is going to go to zero. That could happen if the underlying assets inside that fund, like Tesla in this case, or the NASDAQ 100 in this, in QQQY's case, go to zero. So hopefully you learned something from this video. Give me a thumbs up, and remember this next time you read about stock split or a reverse stock split. It literally means nothing. The value of your investment does not change. Take care, everyone. See you next time.